Hey, what's going on, 10 bagger? I've got a stock pick for you. You've definitely heard of it, but it's a 2 to 2.5 bagger. Hear me out. Carnival Cruise Lines. They were trading between $50 to $60 prior to COVID hitting, and now they're only between 23 to 25. So if this could recover back to its pre-pandemic highs, we're looking at least a 2 bagger, right? If you're new to the channel, welcome. I'm a self-made millionaire investor and I want to help you find attractive single names to help you beat the market. Now, before I get into this video, I should just say this is completely monkey math. This is garbage and you should absolutely do your homework and look at the financials, look at the debt, look at relative safety, look at the credit ratings, look at all of that, look at where it's going. But if you just want a quick and dirty way of finding ideas, right? I think the percentage of the 52-week higher, percentage of its COVID lows, particularly for cyclical companies, is a good starting point. It's not like tech companies where this new product has to be a success. They have to capture X or Y percentage of incremental market share. None of that. All right, enough talk. Let's get into it. The first and most important consideration is dilution. In other words, issuing more shares and diluting existing shareholders. Let's take Delta Airlines for instance. Prior to COVID hitting, they were trading in the high 50s, low 60s range, and now they're closer to the low 40s. So before you make that deduction and think that you can capture a 50% upside if it returns to its pre-COVID highs, let's pay attention to the number of shares outstanding. So here I'm getting this from CapIQ. You can use pretty much any finance data source, Yahoo Finance, Bloomberg, etc. to get this figure. It's not going to change. But if we look prior to COVID, Delta had 637 million diluted shares outstanding, and they're at 642 million today. So there's actually very little dilution embedded in that share price. So 50% upside, that's probably consistent to what you would expect under that scenario. Now, that doesn't entirely surprise me. Delta is a pretty well-run airline. They had one of the best balance sheets, the cleanest balance sheets prior to the pandemic. Not as clean as, let's say, a Southwest, but up there. Now, let's take a look at an American Airlines. They had more debt, a newer fleet, which helped contribute to that debt. They had 426 million shares prior to COVID, and now they're sitting at 656. So that's a whopping 54% increase. So if you're looking at the stock chart pre-COVID and you're thinking, okay, American Airlines was at $28 per share. They're now at 21, so there's a 50% upside there. That's not quite correct. You have to divide the 28 by 1.54, or the dilution factor in this case. And if you're thinking, wait a minute, that gets me only $18 or $19 per share. So in other words, is American actually worth more today than it was prior to COVID? You'd be exactly right. Luckily, we can visualize these returns across the different assets. So go to Google, type in market cap chart for your particular sector, and it should show something like this. And as you can see, lo and behold, American is worth more today than it was prior to the pandemic. And with Delta, you actually see the potential for a 50% return. If we look at the dilution across major airlines, Delta, as we discussed, has minimal, United about 30%, American at 54%, and then if we look at some of the other sectors that got hit, like cruise lines, Carnival Cruise Lines has a whopping 65% dilution. Okay, that's dilution. Now, the second thing you want to pay attention to is the debt service or the long-term debt. And this has been making a lot of headlines recently with Evergrande, but generally speaking, it's more prevalent with more of your cyclical travel and leisure companies. So my view of debt is that it's not necessarily a bad thing. I prefer to share issuances any day of the week, but the downside is it's often a precursor to share dilution. See, what tends to happen is that when the share price rises consistently, let's say you're 50% the way to your recovery target, then you get to 60%, then 70%, then 80%, then lo and behold, you get one of these notices and bam, the company stock falls instantaneously. That is the problem with lots and lots of debt on the balance sheet. The company's CFO, their finance team, they're going to look at the share price and think, okay, now is an attractive time to sell shares, recoup some of that money, clean up the balance sheet. And that's good for the company, but for you as an investor, it just means it takes that much longer for you to reach your target. So if you're looking for a 40% return over a 1-year period, which is a pretty good return, by the way, it just takes you that much longer, and you should expect more hiccups along the way if the company is highly leveraged, meaning it has a lot of debt on its balance sheet. So guys, hope that was helpful. This is a very simple video. Like I said, I just want to take some of the monkeyness out of the monkey math that we're doing, but stick around. In the next video, I'll be doing a deep dive of some of the cyclical opportunities following this September dip, following this peak COVID season. I'm going to be ranking the top recovery plays in my personal opinion, and you don't want to miss out on that. I'll be personally putting a lot of my capital to work in this sector in the next 1 to 2 months or so, and I'm happy to share my ideas with you guys. All right, that's it for this video. Thanks so much for tuning in. As always, nothing is more important than your time, except for maybe your money, and I'll catch you on the next one.